So, hey everybody, welcome. Real quick on some housekeeping items. As you can probably tell, I'm the only one that isn't muted. Well, really, that's just to ensure everyone's time is respected and I can cover a lot of ground. But I want to know what questions you have. I'm going to try to record this to share with those folks who couldn't join live. But since you are here live with us today, you might have immediate questions. Just enter them in the chat, and I'll be watching and try to get to them all. If by chance I can't, I'm going to compile all those questions and answers into an email that I'll send to you right after we wrap up. So, okay, let's get started. I'd first like to quickly go over the basics of a long-term care policy. Then I'm going to talk about the things that are the same with traditional and hybrid plans. Then we're going to dive into the differences. And finally, I'm going to address some of the most frequent questions I get about long-term care protection. So 5 years ago, I wrote a book on home care. It's Finding Freedom at Home, The Ultimate Guide to Home Care. I've got one around here somewhere. I wrote it for families who were exploring care options for a loved one. In it, I included a short chapter on long-term care. It really was a short description of what people who were in need of care right then should be looking at on their policy. And I described 3 components of the greatest importance to them at that point. First, the elimination period. Just as your auto and homeowners and even health insurance all have a deductible, the same is typically true of a long-term care policy. Only instead of a dollar figure, it's represented in time, and it's called the elimination period. Might be 90 days, that's the most typical I see, but could be a different length of time or could be 0 days. During this period of time, whatever it is, the insured would be responsible to pay for care out of pocket. That's their deductible. Now, the second part was the daily, weekly, or monthly benefit. It's the amount of coverage available for approved services. Now, most every traditional long-term care insurance plan was and is designed to reimburse for approved care. So the benefit might be represented by, say, $250 a day or $4,000 a month or something like that. Now, the final aspect I told them to look at was their lifetime maximum benefit. That's the total amount the insurance company will pay over the entire duration of the claim. Now, speaking very roughly, it wasn't uncommon to see a monthly benefit, that very roughly equaled their annual premium. So that's not a hard and fast rule, but it's a very rough estimate of the traditional long-term care policies. Now, that's what people who already had long-term care insurance need to look at to refresh their memories on the coverages in their policies. For those of us exploring getting a policy today, you also should look at those features, but there are many more variables to consider on the front end, and that's what we're going to look at over the next few minutes. Now, there are many similar aspects between a traditional and a hybrid long-term care policy. But to understand why that's important, we first need to understand the primary difference between the two types. Now, a traditional long-term care insurance policy, I sometimes refer to it as a legacy policy or even an old school policy. It's a stand-alone policy. It exclusively covers a potential long-term care situation, period. Think of it as a type of health insurance policy with similarities to something like a cancer policy. If you're diagnosed with cancer and you have a cancer policy, you receive the benefits. With the traditional long-term care policy, a typical trigger for benefits is a need for assistance with 2 of 6 activities of daily living: bathing, dressing, feeding, transferring, toileting, and personal hygiene, or a cognitive impairment that requires supervision. The clients I served when I owned my home care agency had old school policies. They bought their policies 10, 15 years ago. They were the old school policies. Now, a hybrid long-term care plan is built on a life insurance chassis. It includes both living benefits, the long-term care provisions, and the death benefit. The benefits are linked, meaning that if you never experienced an extended care situation and never used the long-term care benefits, the entire death benefit would be paid to your beneficiaries. Now, typically, as you use the long-term care benefits, the death benefit decreases accordingly. Now, makes sense, right? So I do see a question, two questions, but hold those thoughts because I am getting to them. So, okay, so how are they similar? And what's the same with the traditional and a hybrid long-term care plan? Well, one, they both have a benefit, obviously. Now, they both have a daily or monthly benefit available once care is needed. They both have a maximum lifetime benefit. Now, a quick note on that. Excuse me, quick note. Some of the earlier and now mostly discontinued traditional policies had lifetime or even indefinite benefits. Now, as you might imagine, this might be one of the reasons that most companies that marketed traditional long-term care policies are no longer doing so, and possibly a contributing factor to those who are still writing traditional policies to have had substantial rate increases. But the bottom line is really that both types of policies provide long-term care benefits. Now, the triggers, the activities of daily living or cognitive impairment triggers, both of them also look to a need for assistance with very typically 2 of 6 activities of daily living. You need to require assistance with 2 of those 6 ADLs, as they're called, or have been diagnosed with a cognitive impairment like Alzheimer's. And that's an indication that care is required and a claim is appropriate. In most cases, both of them contain at least an option to purchase inflation protection. In most cases, both types of policies allow you to add inflation protection, so your benefit increases over time to keep up with inflation. Now, what's different between the two? It's the differences that really make, at least in my mind, a hybrid plan so attractive to so many people today. One difference is the premium. Yep, and I do see the question. I'm going to answer it right now. It's absolutely true that a traditional long-term care policy can come with a less costly premium. They're less expensive. However, I caution my clients that the cost savings come with a high price. Now, let me explain that. As I've noted, traditional plans are seeing substantial premium rate increases on the existing policies. Genworth, one of the leading, if not the leading, long-term care provider, that they recently announced a hefty premium increase, and the other companies are sure to follow. But that's not even the worst part with the premium difference. Because of its standalone design, if you never require services or care before you pass away, those premium dollars are simply gone. They're vanished. You get zero, nada, nothing in return. Or you could be like the family I served. Like I say, when I owned my home care agency, I started service on a Friday. My agency started providing care on Friday. We faxed the claim information to the insurance company on Monday. The lady died on Tuesday. She received absolutely nothing in benefit from her traditional long-term care plan. The family really questioned that, and they were not happy. Now, because a hybrid plan is built on a life insurance foundation and benefits will be paid at some point, the premium is a little higher. Another difference, underwriting. With the traditional long-term care insurance policy, the company is determining their risk. The insurance company determines their risk based on the probability of your need for assistance with those 2 of 6 activities of daily living. I'm probably oversimplifying, but the underwriting is looking at your health and projected health, and therefore underwriting can be fairly stringent. Now, a typical hybrid policy requires no lab work, and an attending physician statement is only required if there's a cause in most cases. Now, there are some that require traditional underwriting, and that could include a paramed exam, resting EKG, blood and urine samples, etc. But so this can, but it might not be the same between a traditional and hybrid. It's most typically different. So that's why I stick it in the different as opposed to the similarity column. The benefit. Now, I know I listed it also as a similarity, but it might also be a difference. Most every traditional plan reimburses for approved expenses. Now, what that means is that you have to send in receipts or proof of paid invoices to the insurance claims department in order to be reimbursed for those expenses up to your policy limits. Now, some hybrid plans also require this. Others, frankly, the ones I prefer, are indemnity plans. Now, that simply means that once a claim is initiated and approved, you receive the monthly benefit every month, regardless of your actual expenses. This gives you much more flexibility and cuts down on administrative roles of a spouse, for example. Another difference, the death benefit. We've already discussed a traditional long-term care plan has no death benefit. There's no life insurance component. With the hybrid, there are both long-term care and life, or rather death, benefits. This is one of the most attractive features of a hybrid plan versus a traditional long-term care plan. Now, another question I want to jump on right away before I forget it, the benefit period. With most, and I think all, currently available traditional long-term care policies, you can select a period of 2 to 6 or even 7 years as a benefit period. The same is true of a hybrid plan. But as an aside, that maximum benefit period is derived from taking the lifetime benefit and dividing it by the monthly benefit. With a reimbursement type plan, where you're simply being reimbursed up to the monthly limits on your actual expenses, the total benefit period, the lifetime benefit period, could extend longer if your actual expenses are less than the maximum monthly benefit. Does that make sense? I see some thumbs up. But payment options, as you might guess, both types of policies come with a premium, obviously. But don't think of a hybrid plan as I'll pay starting now and continue paying until I need care type of policy. Though that option is possible based on the type of hybrid coverage you get. The premium payment options are flexible and in most cases allow a single premium, for example. Some people want to do a 1035 exchange from another account. You might pay it over 5 years, 7 years, 10 years, 15 years, 20 years, or until you require assistance or pass away. Now, after the final premium, with whatever the length of time you've selected, the policy is paid up and won't require additional premiums to be paid. So if you've chosen 5 years to pay that premium at the beginning of year 6, it's paid up. You owe nothing, it's totally paid up. The benefit will always be there for you. Now, a variable in determining those payment options is your age. The older you are when you get the policy, the fewer options will be available and your premium timetable might be condensed. Now, another significant difference between a traditional and hybrid plan is that the premium rates with a hybrid are fixed. They're not going up. They won't be raised or increased like is becoming so common with the traditional long-term care policy. So what's the right benefit amount? Well, this varies, and there's no one right answer. I'll try to answer that through sharing my experience here in Little Rock, but clearly the cost of care or a skilled nursing facility, assisted living facilities, that they vary by location. But here, my experience, our average client, and that's based on all our clients over an entire decade. Actually, it excludes those that we served around the clock, 24 hours a day, 7 days a week, and excluded those that we were with 2 or maybe 4 hours every week. So excluding those, our average client required home care services 36 hours a week. Now, that's someone that had met the qualification, they needed assistance with 2 of 6 activities of daily living. Now, that's roughly 150 hours a month. And like I say, we serve many clients with Alzheimer's who required continuous support 24 hours a day, 7 days a week. When I sold my agency, we were charging a fair rate of $20 an hour. So you can do the math. But I'll help. Our average client was paying a little over $3,000 per month. So somewhere in the $3,000 to $6,000 a month in benefit is about average and fits most people, whether they choose an old school plan or a hybrid plan. Now, with the hybrid policy, again, because it's built on a life insurance chassis where death benefits are almost always received tax-free, the design is such to maintain fair tax advantages. That being said, typically a daily benefit is capped at, now today, at $370. Now that's the IRS approved daily rate. Receiving benefits above this amount, and that is possible, might trigger a tax event for you. But based on that $370 figure, that equals a little over $11,000 a month in benefit. Or the 370 by 30. Put another way, it would represent at the $20 per hour for a home care aide, 18 hours a day of care. And I see this question, I'll tackle this. Actually, a couple people had this question. How long should the benefit be? How many years? Well, like the benefit amount, the benefit period can be a shifting target. My experience is that 2 years would be a minimum to consider as you're exploring your options, and 7 would probably be the maximum. Frankly, the sweet spot is probably between 3 and 5 years of protection. Now, if we're comfortable with the $370 per day benefit, and I am, that comes to $135,000, a little over that, over the course of an entire year. 370 times 365 days. Now, multiply that by 3 years, and you get a little over 400,000 on the low end. Multiply it by 5, and you get over 650,000 on the high end. Now, something somewhere in the middle is probably absolutely acceptable as you're looking at what benefit should I get. And again, regardless of the plan type, whether it's traditional or hybrid, somewhere between 400 and 600, 650 total benefit is probably a perfectly acceptable benefit, lifetime benefit for most every person. Not a hard and fast rule. If you require care 24 hours a day, 7 days a week for years and years on end, clearly you're going to exceed that amount. Now, we haven't covered what age to get a policy, so let's tackle that. There's different schools of thought on the subject, and no 2 situations are exactly the same. Dave Ramsey says, get your policy at age 60. Other financial experts suggest, and the numbers indicate that this may be true, that the value is even greater if purchased in your 50s. And still other experts suggest that if the right hybrid is purchased, your 40s could be the best time, especially if there's also a need for life insurance protection, possibly due to family medical history. Clearly, the premium cost, and again, that premium is locked in at whatever age you get it, but that premium cost increases the later you wait to purchase protection. But whenever it is, like I say, the premiums will be locked in and not increase. A question I get every now and then is, who shouldn't even consider long-term care insurance? In fact, I see it now. And that's a good question. And let's just tackle it head on. But first off, if you have liquid assets in excess of $2 million, and Dave Ramsey would agree with this, you're probably okay. You don't need this. If you've got $2 million in liquid assets that you can immediately transfer and pay for care or pay for that skilled nursing facility, you're probably okay. But the second, if you might have difficulty paying the premiums or have a modest income and few assets, you might not want to pursue the policy. And then lastly, if you have substantial health issues that would prevent underwriting approval, it probably isn't for you. So real quickly, I want to share 3 scenarios of recent clients. The first was a husband and wife who they're in their early 60s. They wanted a joint policy that covered both of them. And I have one favorite policy for this type of coverage, a joint hybrid policy. Their policy has a little over $5,000 a month long-term care benefit for each of them. $5,000 for him, $5,000 for her. It comes with a death benefit of close to $175,000, which, as you remember, is linked, in this particular case, is linked to a portion, roughly half, of their long-term care benefits. But again, it doesn't represent the entire benefit. And the premiums are paid out over a 20-year period. That was the period of time they wanted to pay their premiums. In their case, their annual premium was $7,000, and that covered both of them. Both of them were protected with really a good benefit, monthly benefit for $7,000 a month. As you can see, 1 month, 2 months, and they made back a year in their annual premium. 2 months of care, receiving that full $5,000 a month. They've exceeded what they paid in a year in premium. So that was a couple. I've also got a favorite joint policy for a traditional plan. Though we don't see many folks choosing the traditional plans anymore. So a second one was a lady who's widowed. Now, like the first couple, she didn't want to pay premiums forever, but 15 years seemed to be the right length of time for her. Like them, she purchased a $5,000 a month long-term care benefit with a 6-year maximum benefit period. So her initial death benefit was $120,000. And even if, let me give you a scenario, even if she requires long-term care services that totally use up her complete benefit, which in her case was $360,000. If she requires care and it completely uses up that $360,000, this policy still has a $10,000 life insurance benefit as somewhat of a residual benefit. Her premium for 15 years, after which time the policy is fully paid for, is around $5,500. So you see, it would take her 1 month. Well, actually, it goes back to my rough rule of thumb, which was her annual premium equaled roughly 1 month of long-term care benefit. Now, the third case I wanted to share was actually in her late 40s. She's a business owner, and in our initial meeting, which, by the way, was also conducted on Zoom, that we both had our video and audio running, I discovered that she also needed substantial life insurance protection. In her case, as opposed to the other two, in her case, I tailored an indexed universal life insurance policy that included a large term insurance component to keep the cost down. She purchased a $1 million policy. It's what she needed to protect her business and her family. If she were to pass away, her family would receive that entire death benefit. If she sells the business and no longer needs the life insurance component of the coverage, or she just needs the cash for her business, she'll have full access to the cash value of the policy. And she really loved that aspect of her policy that really had nothing to do with either a death benefit or long-term care benefits, which was the very reason she called me in the first place. However, assuming she kept the policy and later in life she required long-term care services, which again was her reason for even reaching out to me in the first place, that same figure would be available to pay for care or assisted living or skilled nursing facility care or even home modifications to make her home more suitable to accommodate care and empower as much independence as possible as even though she was experiencing an extended care situation. So she's killed two birds with one stone, and she's now paying $625 a month for this exceptionally flexible policy. She thought that she was going to be paying that much for the life and that much for her long-term care policy. We very literally combined the two and provided the coverage she needed at a much reduced cost. Oh, and I guess I ought to explain. This lady's business is in-home senior care. Probably more than any other profession, she recognized the need for and value of long-term care protection. She's seen up close and personal those families whose loved one has long-term care insurance and those who haven't. She knows better than probably anyone that emotional, physical, and financial burden that an extended care situation can put your loved ones in. And she was committed to addressing that possibility to protect her husband and children from those burdens. Now, as an aside, this is actually a funny story. She had a young, and I realized I realized that young is a relative term anymore. You see my hair is going blonde. She had a young man who works for her who listened into our conversation. I discovered later. I didn't mind. He's in his late 30s, and he called me to say everything he heard us discuss made perfect sense to him, and he wanted something similar. So we had to talk, and I explained to him the danger of becoming insurance rich and cash poor. But I told him, I said, even so, let's take a look. So I came up with a solution for him that he seemed to be appreciative of. For him, I simply wrote a term policy that has an option to convert to an indexed universal life policy in the future. I guess I only share that to say that there really isn't a one-size-fits-all plan. And since I'm the one looking back at me in the mirror, and I don't want to look at someone who I suspect might not always do the right thing by his clients, I want you to know that I always individually tailor a solution. And just as I wouldn't want anybody trying to sell my sisters something they couldn't afford or might not need or want, I do the same with my clients. Now, largely because we're making healthier lifestyle choices, and there have been just tremendous medical and scientific advances. We're living longer these days. I mean, it seems perfectly reasonable to assume we'll live long lives. However, if that's the case, it also seems just as reasonable to assume that at some point in our long lives, we'll require assistance. The statistics indicate that 1 out of every 1.4 older adults experience an extended healthcare situation. When you remove the use it or lose it gamble from the scenario, a hybrid long-term care policy simply makes good sense. And remember those emotional, physical, and financial burdens a family experiences when a spouse or parent requires long-term care? Well, this type of policy can help mitigate and drastically reduce the financial impact while easing both the emotional and physical strain. But sadly, most Americans, quote, plan on a spouse or adult daughter taking care of them should they ever require assistance. And that's in spite of those same people saying they don't want to burden their spouse or children. Okay, enough of that. There are a few more questions, but it looks like we're coming close to being out of time. So like I promised, I'll compile those questions and answers and email those out to you. And by the way, I'd welcome the opportunity to talk with you one-on-one via a video conference, much like this, to discuss your individual plan. In fact, I've made it super easy for you. Simply hop on my personal calendar. I think there's a link below, above, somewhere. Choose a time that's convenient for you and schedule me. I'll send you a link to our private virtual meeting. And like I say, since every plan I design is individually tailored, it typically takes me a couple hours of work after we visit to craft a few options for you. So thank you for joining me on this Lunch and Learn today. I hope there was something of value in it for you today. Have a great afternoon.